What's up, good people? Good morning, good afternoon, good evening. Whenever you're tapping into this video, thank you for joining. I want you to do me two favors. The first one is I need you to smash that like button. That gets YouTube's attention. It gets the algorithm's attention and gets us spread out to more people so we can help more people get to their financial freedom. So please, if you don't mind, do me that huge favor. Hit that thumbs up button for me. Hit it 1,000 times. I really would appreciate it. Also, if you want up to 12 free stocks from Webull, Webull is going to give you up to 12 free stocks when you open a new Webull brokerage account. Put any amount of money in that brokerage account. They're going to give you up to 12 free stocks for just trying out their brokerage app. There's a link down in the description box of this video. Click on that Webull link. Open up your new Webull account today. Go get that free stock. Go get that free money. I'm going to also send you a Webull tutorial video to walk you through how to use the Webull app to make your first trade. All you got to do is send me a DM on Instagram at RichardFane28. Let me know you've opened the Webull account, you've funded the Webull account, and I'm going to send you that free tutorial video so that you can start buying your favorite companies, your favorite ETFs, and start building wealth immediately. The Fed just made it super hard to get rich. And I'm going to walk you through why I believe that. But better yet, I'm going to give you some solutions to get around that obstacle. Just got to hang in there with me and enjoy the journey. We know the Fed had a meeting earlier this week. And in that meeting, they decided not to increase short-term interest rates. Now, they've increased short-term interest rates 11 times over the last 18 to 20 months. And the reason they're increasing interest rates or short-term interest rates, AKA the Fed funds rate, is because of high inflation. Inflation peaked in June of 2022 at 9%. So the prices of our goods and services year over year, as of June 2022, went up by 9%. And that was not something that the Fed liked. They want our inflation to be around 2% a year. And that's basically 2% a year, goods and services go up in price. That's where we're most comfortable. That's where our economy thrives the best. Because why? Most people will get a cost of living raise of around 3 to 4% a year. So if prices of goods and services go up by 2% a year, your wage increase is higher than the price of your goods and services going up. People should be able to afford that. They should be good to go. But when prices go up by 9% and your wages go up by 4%, you don't have to be a rocket scientist to figure out your increase in goods and services are going up faster than your wages. That's a problem. That doesn't create price stability in our economy, and the Fed just can't have that. So they started increasing short-term interest rates to make it tough for people to borrow money, make it tough for companies to borrow money cheaply, and therefore slow down the economy. When you slow down the economy, the Fed believes prices should come down. And that's the whole thing that the Fed has been trying to do over these last 18 to 20 months. They're trying to bring prices down and create price stability in our economy. The problem with that is when you jack up interest rates, you really do hurt assets, right? Assets grow better when interest rates are low. And if I'm an investor, like I am, and like many of you are, we want our investments into assets to grow. But typically when interest rates are high, those assets don't grow as fast. They may have a negative growth. Therefore, over the last 18 to 20 months, the Fed really has made it harder for us to get rich. Why? Because they've increased interest rates to the point where our assets are not growing as fast. So therefore, we're not getting to our pot of gold at the end of the rainbow quicker. We're getting there slower. Now, how can we as investors try to get around that obstacle? Because we know the Fed is not going to decrease interest rates anytime soon. According to Fed Chair Jerome Powell in his remarks on September 20th, he said it'll probably be June of 2024 before they will even consider reducing the short-term interest rate, or AKA Fed funds rate. That's a good little while from now, guys. That's almost 9 months from now. I want my assets to grow. I want to build wealth in those 9 months. I don't want to wait till interest rates come down. So here are some things that I want you guys to be thinking about, and things that I'm going to be doing myself in order to make sure I can multiply my money even in this high interest rate environment we find ourselves in today. The first thing I gotta do is I gotta really be patient, right? I gotta develop a level of patience because I don't want to apply unneeded financial pressure on myself by thinking I gotta go out and do something extraordinary with my money and take a whole lot of risks with my money just to try to get my assets to grow. So I got to develop a level of patience and kind of sit back and wait to see exactly what are the right investments for me, and then do the necessary research to make sure those investments align with my investment tolerance and my investment strategy. So we gotta, number one thing is develop a sense of patience. The second thing that I've started doing is looking for opportunities to get a 4 to 5% return on the money that I have that's just sitting idle at the local bank or my local credit union. So I've decided to go look online to find high yield money market or high yield savings accounts that could pay me 4 to 5% on my idle balances while I just wait in order to look for the right type of investment to multiply my money. So high yield savings accounts out there, guys, online, typically that's where you find them. It's going to be sort of like virtual online banks. Now, what I will tell you is you want to make sure these banks or credit unions or fintech companies are FDIC insured. You want to make sure that there is deposit insurance that will cover you in the event this particular bank or credit union goes away. You want to make sure you're under FDIC insurance. And normally what I tell folks is I don't take the word of that particular bank or credit union online. What I do is I go out to the FDIC website and then I search for that particular institution to make sure that institution is locked in under FDIC insurance. That's the number one thing I do, right? And I also got to understand FDIC insurance only will cover me up to $250,000, right? So if I have a $500,000 and I want to protect it all, but I want to also get that 4 to 5% high yield money market, high yield savings account rate that a lot of online banks are offering, then I'm gonna have to split that up. I'm gonna have to take 250, go to online bank A. I'm gonna have to take 250, go to online bank B, so that I can get all $500,000 covered. Now I know some of you are saying, Richard, hey man, I ain't gotta worry about that. I don't have $500,000 just laying around. That's okay, and I understand that. But no matter what amount of money you got laying around, or that you got in your local bank or your credit union, if they're not paying you at least a 4 to 5% high yield money market or savings rate, then you got to consider potentially moving that money somewhere where you can get that type of return. Because remember, with interest rates being as high as they are, honestly, a high yield savings, high yield money market short term will provide you a certain level of growth on that money, right? Because when interest rates are higher, banks typically will pay you a higher interest rate on your deposits, right? So if I got 50K, 25K, 15K sitting in an emergency fund or sitting on the sideline that I'm gonna do something with in a couple of years, so I don't necessarily wanna try to put it in the market, then go out online and find you an FDIC insured institution who will pay you a 4 to 5% rate of return on your money market or your high yield savings. And guys, they are out there. Now, I'm not gonna recommend any to you guys. You need to grab the bull by the horns, go out online, use Google, and search for it. They're out there. Believe me, they are out there. I got one of my accounts over at Vanguard. I'll say that because that's where I got my account. Over at Vanguard, one of my bigger accounts, it's earning right now 5.275, where I have it sit there until I'm ready to deploy it in its next investment. I just rolled it out of one investment, getting ready to roll it into something else here very soon. But in the meantime, while it sits there, I'm getting a 5.27% return. Now, that is not FDIC insured, but I'm okay with that because it's Vanguard, right? It's not FDIC insured, so don't go to Vanguard thinking you're gonna get that. It's not FDIC insured. But like I said, I'm comfortable with that because I use Vanguard for a lot of different stuff. And right now, I'm getting a really good return on that money that's sitting idle. Like I said, over 5%, which is a thumbs up. I can continue to build my wealth through that 5% interest rate until I'm ready to deploy it to get a higher rate of return. And that's all I'm telling you. Go online, take a look, get yourself in a high yield money market, get yourself in a high yield savings that's gonna pay you 4 to 5% and continue short term at least growing your wealth. The third thing I want you to think about when it comes to multiplying your money, given the fact we're in this high interest rate environment and assets are not growing as fast, is look for distressed investments or assets. And here's what I mean. Real estate, for example, right now, right? Real estate for income, 1 to 4 family dwellings are pretty high from a price standpoint, right? And that's because we have low inventory. But that price point that's real high is for something that's turnkey and ready to move into or ready to put a tenant in. Those are typically the higher end, higher prices properties out there. But if you go find a property in a really good location and it's distressed, let's say the property is vacant, it don't have a tenant in it, or it needs some TLC, some cosmetic TLC, and you know, the grass is overgrown, the weeds are overgrown, maybe it needs a fresh coat of paint, maybe it needs, you know, maybe a new driveway, maybe you need to get inside the house and put in some new appliances, maybe do some new flooring, maybe paint on the inside, you know, just cosmetic TLC. But since it's in a state of disrepair and it can't be rented, maybe you get that property for a discount. Even though home prices are pretty dang on high, that's for turnkey properties that's ready to roll that need no TLC. What I would be on the lookout for is distressed properties, right? Now, the key to buying distressed properties is you want to buy them in really good neighborhoods And you want to stay away from properties with structural damage. You only want to buy properties, in my opinion, with cosmetic things that need to be done. You don't want to be fooling around buying properties that have foundation issues, right? Or that kind of thing. You want to stick to properties that are just in cosmetic disrepair. And guess what you do? You go in, make a below market offer. And why would a seller consider that? Because typically, if the property is distressed and it's just sitting there in a state of disrepair, it doesn't have a tenant in it, no one's living in it, that tells me people are probably a little bit more motivated to sell it since they're not doing anything to get it up to par so they can sell it at market rate. They're probably willing to let that property go for under market. So you could probably make an offer and buy it, 10, 15, 20% below what market is for a turnkey property. And guess what? You go in, do the painting, cut the grass, right? Put some new appliances in there. You add value by doing that. And then guess what? You bought a property for 20% on the market. Now, once you add that value to it, now it's at market. And now you got like a 20% equity in that property immediately. So that's one way a person who wants to still invest in real estate, but doesn't want to pay full market rate, they want to pay below market. That's what you do. You go out and find you some distressed properties, and then you can add some value to it. Now, you got to be careful. If you got to pay for these properties by going to a bank to get a loan, you're going to have to incorporate that 7.5% interest rate that the bank is going to offer you for a 30-year fixed rate mortgage. You're going to need to incorporate that into your cash flow analysis before you make an offer on the property. Now, if you got cash and you're going to pay straight cash for it, you're in good business. But if you got to go out and get a loan, you do got to understand you need to make sure you do a cash flow analysis, including the mortgage expense at 7.5%, along with the other normal expenses associated with the property, plus whatever TLC cost that you got to throw in there to get the thing back up to market. But that is a way to buy real estate in today's environment with these high prices by finding something that's distressed. You can do the same thing with stocks. You can go look at companies who historically have traded higher than where they're trading at right now. And you can also think to yourself, hey, this is a good company, but for whatever reason, they're trading 20, 30, 40% below where they normally would trade. Is there something going on that I can take advantage of, buy at a discount, buy while this company is kind of in a distressed situation, and then hopefully over time, new management comes in, they come up with a new product or service, or they just become profitable again. And now all of a sudden, boom, I just made a 20, 30, 40% increase in my investment by buying stock in this company when it was in its distressed state. So you can also do that as well with individual stock. A lot harder with individual stock, in my opinion, because it's not as straightforward as buying real estate. You really got to know what you're doing if you're going to do that in stock market, because you don't have real access to these companies. All you have is a little bit of information you're going to see online, which sometimes doesn't tell you the real truth why these companies are in a distressed situation. Whereas with a piece of real estate, you can just go out to the property, you can put your eyeballs on it, you can touch it, you can feel it, you can have a professional home inspector come out and really do a thorough evaluation of the property to make sure there's no structural damage. So you can do all of that stuff with real estate. It's really hard to do that with a company who's in a distressed situation and you're thinking about buying their stock. So be careful there. But it is a way to deploy money right now with interest rates being so high and hopefully give yourself an opportunity to hit a home run, right? Let's move on to number 4, which is going to be buying Treasury bills, Treasury notes, and Treasury bonds. right? And that's the US government simply saying, hey, lend us some money and we're going to give you a guaranteed rate of return for that money you allow us to borrow from you. And normally with your Treasury bills, that's going to be short term. Your Treasury notes are going to be sort of like midterm, and then your bonds are going to be longer term, right? So you figure out which one, short term, intermediate term, long term, that fits your financial situation. And then there's an interest rate associated, or a yield associated with those three types of basically Treasury instruments. Now, but the good news is you can pick up a 4 to 5% rate of return depending upon how long you want to keep the money tied up in that Treasury instrument, right? And the good news is it's the US government, so it's guaranteed. The only way you don't get your principal and your interest is if the US government fails, right? They just fail. They default. They go bye-bye. Somebody kicks our butt and takes over our country, right? Which that's not likely to happen is my point, guys. But it's a great way to get a guaranteed rate of return through the US government, through Treasury instruments, right? Bills, notes, bonds. Great way to be able to park money, get that 4 to 5% guaranteed rate of return until you're ready to really to deploy that money into something that may give you a higher return once we get interest rates to start coming down. Because I think that's what's going to happen. Once interest rates start coming down and companies are able to borrow money cheaply again and start growing and investing that money into growth, you're going to see the stock market really go in a different direction. I think it'll start leveling itself out and then start going upward for this new bull market we're going to be experiencing, I believe, sometime in 2024. Also, I think what's going to happen with real estate is national home builders, as interest rates come down and it's cheaper for them to borrow money and it's cheaper for Americans to borrow money, I think that's going to help with demand. Once more Americans are able to borrow money to buy a home, that's going to help with demand. Once national home builders feel like they have enough demand, they will go ahead and accelerate building more homes, brand new homes, new construction homes. That's my belief, right? And I think once you get more inventory on the market, obviously home prices will start coming down when there's more inventory. Right now, with little to no inventory, sellers are in a position to do whatever they want to do. It's a seller's market right now. 10, 12 years ago, it was a buyer's market, right? Because we had a surplus of inventory because of the 2008 financial downturn. We had a surplus of inventory and it became a buyer's market. Now we do not. We have a limited supply of inventory, so now it's a seller's market. And I think with more demand, with lowering of interest rates, 30-year fixed rate mortgages, then I think you get more home builders who are willing to do what? Start building new construction and accelerate new construction, which will bring on more inventory, which will do what? I think reduce prices when we get more inventory. Now let's move on to number 5. And this is the strategy that I use consistently and have used consistently over 20 years. And that's just your passive investment strategy. And what I do here is I take a certain amount of money and I invest that money every single month, every single year, and I've been doing it for decades, where I invest it into paper assets in the stock market through dollar cost averaging. I take 1,000, 2,000, 3,000, whatever the number is. I take that money, I invest it into an S&P 500 ETF that tracks the S&P 500 index. And I do that no matter if the market is red, if it's green, if it's in between, it doesn't matter. I set it and forget it. And I just do that every single month. because history tells me if I do that long enough, I will build wealth through paper assets. It's worked out that way for me, guys, for the last 20 years. That's what I did. I just dollar cost average in, good times, bad times, in between times, it didn't matter. And on over a 20-year period, the S&P, the broader stock market, has given me an 8% return or better on that money. And I built wealth. The majority of my paper asset wealth, that's how I built it, right? Not trying to time the market, not trying to do anything fancy, just in the market every single month, every single year for 2 decades. That's what I did. And that is the approach that most of us should consider. It's a proven approach, number one. It works, right? It works, in my opinion. Now, I'm not your financial advisor. I'm not telling you what to do with your money. I'm just giving you options here so that you can maybe take a few of these options, deploy some of your money, and start having it multiply for you. And I think that passive investment strategy, where I don't have to be the expert, all I got to do is set it up on a self-directed brokerage app like Webull, like I've been telling you guys about for a couple of years. The Webull app allows me to do that. So I can go to my Webull app. I can say, okay, I want $1,000 a month coming out of my brokerage account, the cash portion of my brokerage account. I want $1,000 a month, and I want to buy VOO on the 15th of every month. And guess what? The Webull app, through its automated investing, will do that and make that purchase for me. I just got to make sure I got the $1,000 in that cash portion of my brokerage account every single month. Now, if you want to take advantage of that opportunity, there's a link down in the description box for Webull. I would ask you to go open the Webull account, get up to 12 free stocks, try it out, see if you like it, and then make sure you set up automatic investing, right? Where you set it up and forget about it. The only way you turn it off is when you come back and turn it off yourself. I like that because now I'm not on the hook to have to remember to make that VOO investment every single month. It's automated. So that has worked well for me, guys, over the last 20 years of doing that. And I think for me, that was the best course of action to build wealth over my last 20 years. And then I would say the second best course of action was real estate. I bought a lot of my real estate before prices were like through the roof, right? I bought a lot of my real estate after the last downturn, which was 2008. I also bought a lot of real estate prior to 2008. One thing I know about real estate, whether you buy it in good or bad times, if you buy it in a good location where people have a desire to live, you can't lose if you hold the property long term. So if I pay for real estate at today's prices, and let's say a year from now, the prices go down, and I paid about 20% more than what people are paying today, I believe if I keep a tenant in that property, if it's for rental income, if I keep a tenant in that property and I hold it long enough, it will right-size itself. That's been my history with real estate. I bought several properties that ended up underwater, and I just kept the properties. I kept tenants in them. And then over time, they right-sized themselves, and I sold them, and I made good profit. And all the time I had the property, I had a tenant in it, paying rent, and that rent paid all the expenses. It paid the mortgage payment, and it put a little bit of money in my pocket. So real estate is a good way, guys, to build wealth, even right now when prices are high. The key, though, is for most of us, we want to buy under market. So you want to go out and look for distressed properties. Yeah, it's going to take some work. No one's going to just knock on your door and say, hey, you want to buy this house next door and I'm going to give it to you for 20% below market? No, nobody ain't going to do that, man. You got to get out and put some work in. You got to go search and find properties. One of the things I recommend you do is get you a good real estate agent. Tell them what your real estate strategy is and see if they can help you sift through all of these properties and find some good undervalued, distressed properties out there in great neighborhoods. That's the key to buying distressed properties, guys. It's the neighborhood you buy it in. If I can go into a really, really good neighborhood and buy the worst house in that neighborhood and all it needs is cosmetic TLC, that's a winner, winner, chicken dinner. I'm telling you, it's a winner. What you want to stay away from is declining neighborhoods. Neighborhoods people don't have a desire to live in. I wouldn't be buying a lot of that real estate. Not me, not for me. I only want to buy real estate where people want to be at, where people want to live long term. That's where I want to buy real estate. And then I want to buy either a value add property where I can put a little TLC into and then get instant equity when I get it up to market. That's what I want to do with real estate, and that's what I did for many years, guys. So I'm telling you, those are your 5 things that I'm asking you guys to consider, because the Fed has made it super hard to get rich right now with these high interest rates. And they've already said, we ain't lowering them anytime soon. They're not going to lower them for another 9 months. So what are you going to do? Keep your money under your bed mattress? You're going to keep it in a coffee can in the back of your kitchen cabinets? You're going to keep it in your safe at home? You're going to bury it in your backyard? No. Go out and look for some ways to leverage that money depending upon what your risk tolerance is. Look for some ways to leverage that money depending upon how long you want to invest it for. I told you these high yield savings accounts that are FDIC insured are paying 4 to 5%. Go out online and find them. They're there. Just do a Google search for them. Make sure that they're FDIC insured, and I would go to the FDIC website and double check to make sure these guys are insured. I wouldn't take their word online. Oh yeah, we're FDIC. I wouldn't take their word. I'd go to the FDIC website to make sure they're legit. And if they are, and I can get 4 or 5% return, you got to consider it. And then obviously with them Treasury instruments, whether it be a bill, a note, or a bond, right? Find you one of them that's right for you. Get you some return on that guaranteed by the US of A. Good old US of A, right? Guaranteed. And then if you want to get a little bit more aggressive, like I said, go find those distressed assets, right? That's a little bit more aggressive, a little bit more time, a little bit more expertise, but worth it. If you can hit it right, it's worth it, okay? And all that stuff is wrapped up with what? Patience. Gotta have some patience. Gotta have some patience. Gotta be patient in an environment like we're in today, guys. Doesn't mean we don't invest. Doesn't mean we don't dollar cost average in. We do dollar cost average in. We do invest. But we still gotta be patient and not look for home runs. Most of us are not gonna hit home runs on these investments, right? Most of us gonna hit singles, doubles, the occasional triple, but most of us are not gonna hit home runs. So stop looking for home runs. When you're looking for home runs, you do nothing but increase your risk level of losing your money, right? You increase your risk level of you losing your money when you're only out here looking to hit home runs, right? You're not objective. You're not patient, right? Borderline greedy in some cases. So be careful with trying to hit home runs. And you're ripe, very, very ripe for scammers, right? Anybody that comes to you and tells you in this environment, they're going to get you 30, 40, 50% return on your money in a week or two. Just open a crypto account and send me some money and I'm gonna double, triple, quadruple it for you. Guys, come on. That's a scam. That's a scam. So please be careful. Don't allow greed to step in and take over your investment strategy. Make sure you're patient. Make sure you have done some research. And maybe you do 1, 2, 3 of these strategies. I don't know. Personally, myself, I'm doing several of them. I'm definitely doing the savings account strategy with the high yield interest rate, right? I'm definitely doing the passive investment strategy with the dollar cost averaging in every single month, right? I'm doing that strategy. I'm looking into the Treasury securities or Treasury instruments strategy, whether I go bill, note, bond. It just depends on what the interest rates are. So I'm looking into that strategy. And I'm also looking into what? The real estate strategy of buying some distressed properties. I'm starting to get that going again because I got enough cash to pay cash for a property or two if I wanted it, right? I don't have to really go get any loans, but that's predicated on how low or how below market I can get the property for. And then what is it going to cost me from a TLC standpoint to actually get it to market? And then what I probably would end up doing is buying the property cash and then putting a tenant in it. And then when interest rates come down in, I don't know, 12 months, 18 months, when interest rates are 30-year fixed rate mortgages are down below 4%, I think in the next 18 months we should be there. Then at that point I refinance, pull all of my cash back out, take a little bit of equity out as well. And then what do? I keep a tenant in the property, let the rental income pay the mortgage off, and then I keep moving. Take my money, put it in something else. And guess what I'm going to get? I should hopefully get me a little bit of appreciation on the property. So that's the strategy for me. That's what I'm going to be doing over these next 12 to 18 months. I'm not going to try to hit home runs. I'm just going to try to get on base. A nice single, a nice double, an occasional triple. That's good enough for me. I don't look for home runs because I do nothing but increase the exposure of me losing my money because it comes with too much risk. And I'm at an age where I don't need all that risk. I just need a moderate, nice, consistent 8% return on my money, and I'm good to go. I don't need 30%. I don't need 40%. I need 8%, and I'm just going to continue to hit singles, doubles, the occasional triple until I get it. You got to figure out what your strategy is, right? One strategy you don't want to have yourself in is the broke strategy, the no wealth strategy. You don't want that strategy. That's the wrong strategy because you're going to work for somebody for the rest of your life if you got that strategy. You better figure out how to get you a strategy where you're living on less than what you make, a strategy where you actually have a plan that you live by. You have a management plan for your money, a budget where you know how much money coming in, how much money going out. You may want to have that strategy in place. You may want to also not have a lot of consumer debt. Your strategy should be to be debt-free. Consumer debt-free, not necessarily debt-free when it comes to a mortgage for a rental property or your primary residence. I'm okay with those types of loans. Why? Because that's not consumer debt. That's actually an asset. Hopefully, if I bought it in the right location, it's appreciating in value every year. I'm talking about your true consumer debt where it's depreciating. It generates no income. All it does is take money out of your pocket. It puts no money in your pocket. You don't want to have that particular bad strategy. And then obviously you certainly want to have the strategy of saving and investing. Always have that emergency fund, 3 to 6 months tucked away. And that's a good place to put your emergency fund is in one of those high yield savings or money market accounts I talked about earlier. That's a great place to put money, guys. Your emergency fund money. Because what I don't want is my emergency fund commingled with my everyday operating checking account or my everyday operating savings account. I don't want to commingle those funds. I don't want to put those funds together. I want those funds separate. I want it very, very difficult for me to be able to get at my emergency fund. The only time I dip into my emergency fund is if I hit a financial bump in the road and I am required to tap into it because I got no other choice. I'm sick, I can't work. I got fired from my job for whatever reason, and I have no immediate plans of getting work anytime soon, right? Financial hardship is the only time, guys, I touch my emergency fund. I don't touch my emergency fund because you know something? I'm gonna get my income tax refund in February, but I'm gonna go ahead and tap the emergency fund so I can take my Bahamas vacation in November. And then I'm gonna replenish the emergency fund from the tax refund, but I'm gonna go ahead and No, that's not what the emergency fund is there for, guys. It's not for your vacations. No, it's for emergencies, a financial hardship. So please have that. And then you gotta invest. You gotta invest, right? You gotta invest to build wealth, to ultimately do what? Control your time and control what? Your financial destiny, right? Freedom. That's why we're talking about this. That's why I'm doing this video, is so that you know how to get to freedom, right? That's the ultimate goal here, guys. The ultimate goal is not to own a lot of things. The ultimate goal is to be free from having to work for somebody for the rest of your life and never really enjoying the things that you really want to enjoy because you can't go out and do them because you're working or you're broke. That's the whole point of this, right? That's it. I did 2 financial sessions today, one-on-one calls with 2 great young men. And they know who they are if they're watching. 2 great young men I had conversations with today. 2 from 2 different backgrounds, live in 2 different parts of the country, but they had one thing in common. They were seeking financial knowledge to assist them to get to what? Freedom. And man, did we talk about it. We spent an hour talking about things that they can implement to get them there. And that's what I do in my company, RF Financial Consulting, guys. I have these one-on-one calls with folks, right? And we talk about solutions, not problems, right? We only talk about solutions. And then it's up to them to take those solutions and go execute, right? And that's what we spent time. 2 hours of my day was spent doing that. But you know something? I love doing those calls, especially when I got people on the other end who are eager to change something in their financial life. The question is, are you eager to change anything in your financial life? And are you willing to invest in yourself to do that? I don't know. If you are, then certainly look down in the description box of this video. And there is an email address for RF Financial Consulting. Shoot me an email and let's see if I'm the right fit to help you get to your pot of gold at the end of the rainbow. Once again, guys, it's my company. And I do charge a fee to do that 1-hour session. But again, I believe it's an investment in you, not in me, because I'm already at my freedom, right? I'm there. I'm living the life that I've always wanted to live in the community I've always wanted to live in, right? With the freedom and the choices and the time to do anything I want to do that my heart desires. I want that for everyone. And if I can share with you things to help you get there, it may be something you want to consider. Again, you don't have to, but it may be something you want to consider. Well, guys, you've been wonderful. I appreciate you tapping in. Whoever tapped in, thank you. Again, you got to hit that thumbs up for me. Please, please, please hit the thumbs up button. It really helps the channel. It really gets us to a point where we can be viewed and seen by more people. And the more people we can get viewed and seen by, we have the ability to help more people get to their freedom. So you're a part of that equation because you're hitting the thumbs up. And if you hit the thumbs up, that gets us spread out to more people. So please hit the thumbs up for me. Please, please hit it 1,000 times. It really helps the channel and it really helps me too. Also, if you want them 12 free stocks from Webull, matter of fact, let me correct myself. That's up to 12 free stocks from Webull. You got to click on that Webull link down in the description box of the video. Sign up for Webull today. Go get up to 12 free stocks and put yourself in a position where you can start buying paper assets to build your wealth. Remember, we talked about strategy number 5, which is the passive investment strategy. Passive because we're going to be investing in ETFs that are passive investments. And you can do that through the Webull app. You can do dollar cost averaging through the Webull app. You can do automated investing through the Webull app. You can do $5 fractional share trading through the Webull app. But if you don't take yourself off the sideline and put yourself in the game, you can't build wealth. So go check out that Webull link down in the description box. Also, guys, I want you to consider sharing this video with somebody that may get something out of it, right? All I want you to do is share it. Just say, hey, I checked this guy out. Check him out. See what you think. Share it. We want to grow this community. We want to help more people get to their freedom. Don't make that decision for your friends, for your family, for your colleagues, for your acquaintances, for your network. Don't make that decision for them. Share the video. Be part of the solution, not the problem, right? Share the video. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. And I'm going to catch you on the next video. Peace.